I'm Jeff Solomon. I'm a partner at Cherry Bekaert, and I head up the Boston office here. I think I know most of the attendees today, so I'm glad you were all able to join us. I'm excited that you're going to meet Karen and Chris today. I've been working with these guys a lot, and one of the reasons why we made the move to Cherry Bekaert, and I'm so excited for you guys to hear from them today, is because of the expertise that Cherry Bekaert can provide. And this is an area, obviously, that is fraught with problems and exposures and technicalities. So I'm excited that you guys can all join us today. We have a relatively small group, so I think if you want to post your questions to the chat, hopefully we can get to those and maybe even have a little back and forth. We have a seminar coming up in the next couple months on cyber risk, so look for that as well. And I think this webinar today is going to pretty much illuminate certain complexities of state and local taxes, both from an income tax standpoint and from a state sales tax standpoint, which obviously every state has different rules. And guess what? Income tax has different rules and sales tax has different rules. So I'm pleased to introduce our speakers today, Chris Hempel, a good friend of mine already, spending way too much time with me than he probably wants to, and Karen as well, from the SALT group. You should feel free to reach out to them after the seminar if you have any questions. They're a great resource. I use them all the time. So with that, I think I'm going to turn it over to Karen and we'll get going. Karen?
Okay, fine. Can everybody see my screen? Okay,
Yes.
sure. Want to be sure of that. Very important aspect of this, obviously. Welcome, everybody. Thank you for joining us today. I am Karen Boyeris. I'm a director in the income tax group at Cherry Bekaert. And just to give you a little bit of my background, I am a CPA and a JD with an LLM in tax, but don't hold the fact that I'm a JD against me, please. I have basically over 40 years of state tax consulting experience in state and local taxes. I've been in it almost my entire career. And it includes some stints at, well, obviously Cherry Bekaert, where I've been here a few years. And then also I've been at other big four firms. I've been in corporate at two separate corporations, and I even started my career at the Illinois Department of Revenue. So I've handled a lot of different matters, as I'm showing on the screen, in a lot of different industries, because I've been around a while, I have to say. And I'm going to turn it over to Chris next to introduce himself.
Yeah, thanks, Karen. Hi, my name is Chris Hempel. I'm a director in our sales tax practice here within the state and local tax practice at Cherry Bekaert. Been with the firm for just a little over a year now, which just marks how fast time flies. But been doing sales and use tax my whole career, about 18 years now, based in Dallas, Texas. Started my career doing a lot of consultative aspects with respects to refunds for healthcare organizations, where I started with Ryan. From there, transitioned to more of a full service CPA model firm here in Dallas, and then spent time via an acquisition with Baker Tilly, and then transitioned into Cherry Bekaert about a year ago. But yeah, my background is primarily sales tax consulting, handling a lot of nexus analysis, exposure, audit representation, refund reviews, taxability. But then over the course of my career, I've kind of got more involved with the full outsourcing, the compliance solutions, and that's what I'm kind of here to do at Cherry Bekaert, is to help bolster our compliance outsourcing solutions, and assisting clients in that way too. So yeah, as Jeff mentioned, super happy to be here. He was immediately getting us involved with a lot of the client base up in the Boston area markets. So there's been a lot of really good opportunities. So excited to be here, and look forward to eventually meeting each one of you guys too.
Thanks, Chris. I just wanted to also give you an introduction to the Cherry Bekaert SALT group. We have now close to 40 people, 40 professionals in our group. Our primary focus is income tax, sales tax. We do some property tax and also some payroll tax as well. So our big goal is, in the second bullet point, we identify tax risks and remediate state tax exposure. The idea is that we want to be your trusted business advisor when it comes to state and local tax issues. The people in our group, we have quite a variety of experience, as you can see just from the two of us. We have a lot of people in the group who have been at other firms. They've also been in corporate. And so it's really, a wide mixture of experience in our group. Next, what I want to do is kind of spell out, some of the state income tax experiences, services that we provide. I'm not gonna read all of these, but I'm gonna somewhat focus on the ones that I think are the more significant and just kind of explain what the process is for those of you who may not be as familiar with some of these services. So I would say on the income tax side, a really large part of what we do relates to just doing a nexus evaluation and a remediation, if companies are supposed to be filing in states, but they're not filing. So the nexus reviews are basically, are you do you have sufficient activities in the state to require you to file returns? And then let's say you do, but you didn't do it for prior years, what's your exposure and what are some of the ways to remediate that situation? One of the more common ones is, if the exposure is relatively large, you do voluntary disclosure agreements with the states for prior years. So, that's a large part of what we do. We also do a lot of apportionment sourcing. When you file a state income tax return, you basically start with your federal taxable income, you have the state modifications, and then you apportion your income, usually in most states these days based on a sales factor. So apportionment sourcing is a big issue, for service companies based on, do you do it based on where your customer is or where you are providing the activities yourself? And then even with sellers of tangible personal property, there's issues about, do I need to throw back the sales, into the state I'm shipping from if I'm not taxable in the other state? So anyway, and, we have provided numerous other services as well, related to compliance and controversy, transaction assistance, and then flow through entity tax elections for flow through entities looking at those issues. This is just a quick slide to show, what some of the services are that are relevant to different types of industry. But what I have you notice is the first two bullet points in almost everyone is nexus and remediation. That's still a big issue for almost any type of taxpayer. And then, Chris, I'm going to let you explain the sales tax services.
Yeah, so sales tax group at Cherry Bekaert, again, we sit, what I'm really proud of with this group is we sit right alongside our state income tax colleagues. And what we're doing from a state and local tax standpoint is trying to be that overall trusted advisor, looking at it from a holistic standpoint. So for instance, if we have state income tax issues, we're oftentimes working across with our, Karen working across with our sales tax folks and vice versa. If we're having sales tax issues, recognizing that that could trigger income tax. So a very cohesive group. Again, Karen said about 40 team members in total. For the sales tax, we have about 25 team members, complements of partner all the way down through a staff level. Our group is, handling the full spectrum of sales and use tax services. A large portion of it is doing these consulting projects, whether it be an initial analysis that would probably be relevant to this market. We've seen quite a bit, looking at nexus, looking at taxability, looking at potential exposure, bringing remediation solutions to the table, and then helping that, client get involved with implementing the tax technology solution and then transitioning into ongoing compliance. Our group, again, handles ongoing compliance matters as well. We have a team that's handling about 120 clients right now as far as their outsourced solution goes, filing returns in all states, all industries. We're doing about 25,000 returns a year currently. Is where we're sitting right now with ideas to, again, grow and service that kind of full compliance based, market going forward too as well. As far as, thinking through compliance, the next steps is typically if a company gets under audit or if they identify, potential refunds, something our group has handled quite a bit. We have some very good experienced folks whose time has been spent more on the audit management side, refund review type side too. And then we have a lot of team members that are fully immersed in the various technology solutions, and a lot of our team is certified in Avalara as far as helping implement that solution, helping configure it as well. And again, but also just looking at full broad spectrum, being able to assist on any kind of state and local and sales and use tax matter for that regard. Yeah, and again, a couple of industries that we really do dive deep into. We have a lot of industry experience with this group. It's pretty, across the board as far as industries we service. We do have a large amount of e-com, consumer goods, a lot of technology clients and a number of manufacturing clients as well. And again, this kind of just showcases the various services that we would look at, that we've had expertise in each one of these industries. But again, we're pretty industry agnostic. We've seen a lot, we have a lot of experience. We can touch them all, but these are the ones we kind of see the most here at Cherry Bekaert. Go ahead, Ken. Our group does handle property tax services as well. And I'm noting just some issues on here that I didn't fully update this slide. I've seen sales tax compliance, but we do handle property tax outsourcing services primarily within business personal property tax we can do in-house. We are looking to really expand and grow on this market as well. We do have referral partners that we utilize currently for real property matters or appeals that are within our network as well. But we certainly handle business personal property tax compliance across all states as well.
Okay, and that brings us to our first polling question. This should be an easy one. What areas can Cherry Bekaert's SOLVE team assist with? A, income franchise, B, sales and use, C, property tax, or D, all of the above. 2/3 say all of the above, and 1/3 still says income franchise. No, we're much more than that. So next is we're going to be covering nexus, and I will turn that beginning portion over to Chris on that one.
Yeah, so the idea behind our presentation today is really just kind of walking through a little bit of the overall how state and local tax, how sales and use tax, how income franchise, how we approach working with a new client needing to get up into compliance and the items that we're going to start with. So we're going to walk through just kind of the life cycle of an initial analysis with a particular client. Again, these are real, this is the kind of the model we follow and that I worked with a number of Jeff's clients already, as far as when we have these initial discussions of a company's in their growth stage, they're looking to expand, they're getting to the point now where they're thinking, hey, we're in multiple states. How do we go about, what do we need to consider from a sales and use tax or a state income tax standpoint? But the basis of the discussion with any client, honestly, when we talk about multi-state, is this idea of nexus. Very common word in the state and local tax standpoint. Nexus, for the most part, meaning basically a connection with the state that the state deems as engaged in business, where a connection or an engaged in business is tripped. That's where the states can then legally impose the various state and local taxes on a particular company. Each state really has different types of nexus factors. I mean, there's 45 states out there that impose a sales tax, and each one of them has different sets of rules of what's considered nexus, what is considered enough substantial connection and engagement in business that allows a state to then legally impose the state and local taxes on a particular company. But they typically range from a physical presence through economic in general. Here, you can still go back here, Karen. Yeah, it varies. It varies state by state. It varies between sales and use tax and income franchise tax. That's what we'll kind of showcase as we deep into it a little bit. But generally speaking, from a sales and use tax versus income franchise, sales and use tax is typically going to be the more aggressively looked at area for nexus standpoints. Currently, we're seeing income tax kind of catch up, but sales tax, factors have been a little bit more of an aggressive standpoint as far as sales tax nexus. Go ahead, Karen. So again, we look at nexus, typically we look at it in two broad general categories. Again, from a connection or engagement business, we first look at a physical connection. So generally speaking, we first start looking at a company. Do we have any sort of physical presence in a given state where the state could then say, okay, that's a connection with the state. You are engaged in business in my state. We can legally impose. The broad physical nexus items we look at: inventory, whether it be your inventory that's in your warehouses, whether it's consigned inventory that you have at 3PLs or logistics type companies. If it's still your inventory, that's going to be considered a physical presence and a connection with that state. Obviously, your own offices, leased spaces, warehouses, even in some cases, conventions, setting up a booth in a state can give you physical presence nexus, depending on how that state looks at how long you're there. Obviously your workforce, where your employees are, remote employees, even in some cases 1099s. If we have sales agents in other states that are soliciting your sales on your behalf, so independent sales reps can also create a physical presence nexus, is what we're looking at as well. Then typically then also boots on the ground, thinking about performance of services. So if we're going to do a sale of items and an install, we're going on site to that location. If we're crossing state borders, we are essentially now entering the state from a physical standpoint. That's going to generally be enough for the state to claim that you have a nexus, trip that nexus, and then say you now have a legal and compliant requirement too. Good. Okay. In addition to physical, what we've seen since 2018, a very hot topic in 2018, you probably have heard of a lot, the Wayfair case, the Wayfair, South Dakota, Supreme Court case that went up to the US Supreme Court, which essentially allowed states to adopt an economic nexus factor, which is essentially just a threshold of sales in a state during a given time period. And this is not necessarily an and statement to physical nexus. This is a and/or. So if a company has physical nexus, or they have economic nexus, which essentially just simply selling remote sales into a state, surpassing an annual threshold in a certain year, that's going to be enough for the state to then have a legally, be able to legally impose the state and local tax or the sales and use tax on a particular company. Generally speaking, it's a calendar year. When we work with clients, when we're looking at it, we're typically going to look back in a trailing 12 months just to kind of capture the last year's worth of sales. And we're looking at if they are surpassing these thresholds per state in a trailing 12 months, that's something we need to consider on the go forward. Some states do have grace periods. So if you tripped the sales threshold in a given year, they might say you have, a month, 2 months, some say 6 months to then get compliant and registered. And what you're doing at that point is once you trip the nexus in a given state from economic nexus, it's not necessarily applied retroactively. It's going to be once we trip that point, it's going to be a prospective filing and a registration going forward too. It's only going to be retroactive if you've also maybe had a physical presence in that state, or if economic nexus has been established for a number of years. It's going to be that point when the nexus is established that the state can look back. Most states, again, the South Dakota Wayfair case, that was the basis of this. The way South Dakota's rule initially read was 200 transactions, so individual transactions, or $100,000 in a given year, which is pretty low. But that's what was initially adopted as $100,000 per state. What we're seeing lately are states, they are dropping the item requirement. So 200 sales in a given year, just depending on what type of shop you are, that might not be even close to $100,000. It could be far past it, but we're seeing states dropping the itemized thresholds, generally speaking, the 200, and just looking at a dollar amount per year. And then we're also seeing some states recognize that $100,000 was maybe a little bit too low, and they're giving more grace for smaller businesses. You're seeing some of the larger states moving up to maybe $250,000, $500,000 a year. But when we're talking about generally looking at this from a state standpoint, I'm generally looking at, are we hitting $100,000 per year in a state to determine, do we have a filing requirement? And then kind of moving from there. States do differ on what they consider that basis for the $100,000 a year. Some states do consider just total gross sales in the state. Some states make differentiations between wholesale versus retail sales in a state. So as part of that $100,000, it might just be retail sales and not wholesale sales that are going to be later resold. And then some states even go as far as to say just looking at taxable sales in a state. So they all differ, but again, we look at it first from a broad perspective, do we look, are we hitting these thresholds in a state per year and then diving down each to determine the legal filing requirement? One thing that's interesting here, and I'll let kind of Karen opine on this in a second, but just because a nexus is kind of created for sales tax doesn't always mean that nexus is there for income as well. So again, we've talked about before, sales tax has a little bit more of an aggressive stance on nexus, where income tax is going to be a little bit more protected. Karen will go into it, but that's kind of the higher level there. But that's why we got to understand the facts and look at it from a full holistic standpoint.
Okay. And I'm going to leave the slide here a second more because I just want to let you know that on the income tax side, even the economic nexus tests are a little bit different and less clear. So for example, there's really, on the sales tax side, I think pretty much almost every state that imposes a sales tax has passed some type of economic nexus standard. But on the income tax side, you only have about 10 states or so that have actually said, this is what our standards is going to be. Then the question is, well, what about the other states? Well, under the Wayfair case, technically, if they have, a company has more than 100,000 sales in the state or more than 200 transactions, they could potentially be required to file. Also, there's an organization called the Multi-State Tax Commission, which gives recommendations to the state, and some states are members, that uses a $500,000 threshold. So, that area is actually not quite as clear on the income tax side, and I think does cause some confusion. So the other thing is, I've noticed is some of the states will be more aggressive, and I don't have the states listed here, but I've noticed lately like Minnesota, Wisconsin, and basically they kind of take a position, well, if you have really any activity in our state, that may be enough. So these are examples of what the law is in some of the states, and how broad it is, and why sometimes they may say, oh, you still, have a filing requirement. Even if your sales are below that threshold and you don't otherwise have physical nexus. And the one thing that I do want to clarify on the income tax side as well is physical nexus will preempt economic nexus. If you have physical nexus, even if it's a small amount, most states will still say you have a filing requirement, even if you're below the economic nexus threshold. Because I do have a lot of people ask me, is there a de minimis in the state? Well, if you have physical nexus, that concept of de minimis really does not apply. So I think
same applies to the sales tax too, Karen. So if we have physical nexus, regardless of the amount of volume, there likely is some sort of filing requirement, compliance requirement in that state from both perspectives here. So yeah. Good call out.
So the next question is, do companies have any types of protections if they have exceeded economic nexus in the state, for example? And there are some protections out there. This is actually a very old statute, and it was probably the last time Congress has maybe agreed on any type of state and local tax matter. This legislation was passed in 1959, and basically it was passed in response to a court case, which really broadened the nexus concept for a lot of companies. And of course, thinking back to 1959, at that point, weren't that many businesses that were sales of service. It was mostly sales of tangible personal property. So the law that was passed is Public Law 86-272, and it is a federal law. So it preempts the state law in this matter because it's passed under the Commerce Clause of the U.S. Constitution. It basically says that no state can impose a net income tax on an entity where their sole activity in the state is the solicitation of orders for sales of tangible personal property, orders that are sent outside the state for approval, and orders that are shipped from a location outside the state. But what's important to know is there has been, a lot of controversy throughout the years, a lot of court cases on this issue, even some reaching the U.S. Supreme Court. And, there's a lot of nuances to this legislation. So one thing I wanted to point out in this slide is to clarify what it can apply to and what it doesn't apply to. So first of all, it only applies to a situation where you have a net income tax. Okay, so you look at the right-hand column, it doesn't apply to gross receipts, margin taxes, which would be like the Texas franchise tax, net worth taxes, minimum taxes. New Jersey, for example, is a big state that likes to grab their minimum tax. even if you don't otherwise have a filing, or even if you're otherwise covered by the protections of 86-272. Next, it applies only, as I mentioned, to sales of tangible personal property. It does not help companies that sell services, intangibles. And nowadays, I would say most of the states are basically saying, you know, software sold as a service, even electronically delivered, that may not be considered the sale of tangible personal property. I mean, in the old days, you know, people shipped software on a disk. I've been around long enough to remember that, but that's not the way business is done in that area anymore. Next, it applies only to interstate commerce. So that is sales among the states. So in other words, if there is a foreign entity that is shipping into the United States, making sales in the state, it will not be protected by Public Law 86-272. There may be some states that will allow that protection, but they are not required to do so. And this is an area where technically, you know, these provisions do not apply unless the state specifically says that they will. And then the last thing is it applies to a non-domiciliary business. If you are incorporated in the state, if you are a resident in the state, you cannot apply these protections because the concept is, you know, you're formed in the state, you're receiving the protections of the state, and this law should not apply to you. I say with one exception, Delaware, because so many companies are incorporated in Delaware. There is a statutory provision that provides some protections if you're not otherwise doing business, and you know, you may not need to file in that state. And the one other thing that I want to point out about Public Law 86-272, you know, I said there've been a lot of changes through the year, a lot of controversy, is there's kind of two conflicting things that are going on at the moment relating to Public Law 86-272. So first of all, the Multi-State Tax Commission, which I mentioned earlier, adopted some guidance to basically restrict the protections of Public Law 86-272 when they're applying to companies that use the internet at all, like who doesn't, right? So basically what they're saying is, you know, if somebody can send your customer service department an email from a state where you're not filing, that could create nexus. And this is just one of the examples, if you put cookies on the customer's computer, you know, not just relating to that specific order, but let's say relating to some other items, that could create nexus. This was something that the Multi-State Tax Commission recommended in 2021. The states would have to adopt it individually. And there's been a lot of pushback, you know, a lot of litigation relating to this. So for example, California adopted a few years back via, I think it was a bulletin, and it was struck down because procedural provisions were not followed. It wasn't adopted as a regulation. So New Jersey and New York have tried the regulation approach. New Jersey was, I think, still inviting comments. They were going to apply it prospectively. New York, there's some litigation involved. So, you know, these are obviously being highly challenged. And then when I said there's a competing thing going on at the moment, which is kind of interesting, in the current legislation, you know, that just advanced to the Senate in Washington, the House Judiciary Committee in their reconciliation proposal included language expanding protections under Public Law 86-272 to include activities that facilitate the solicitation of orders, even if serving some independently valuable business function apart from solicitation. So obviously, you know, that's not passed. We are not sure what's going to happen with that. But, you know, that is a competing approach, you know, that is at least potentially in the hopper at the moment. And the one other thing that we want to talk about, and this, you know, relates both to sales and income tax at the moment, is the teleworking remote employee issue. Obviously, since COVID, it's become much more common for companies to have employees who maybe work from their home, when we're in a remote location, you know, other than where the company is located. And these can create filing requirements and can trigger nexus in additional states. And in addition, you know, they can create some payroll tax issues as well. So anyway, I just wanted to make sure that we pointed out this issue. And I want to move it to our next polling question, which is, what are the different types of nexus? This is polling question number 2. A, physical, B, economic, C, both physical and economic, and D, it's a hair product.
Yeah, as you guys answered, one thing I wanted to just address, that's when we were talking about sales tax nexus. The why it's more aggressive is because that public law 86-272 only applies to the state income tax side. And that's where their states are allowed to be more aggressive on the sales tax side, picking up that nexus, because that does not apply to the sales tax. So just a clarification of that it's only applicable to the state income tax of that side.
Okay, one thing I wanted to discuss, but I'm just going to discuss it really briefly, is the flow-through entity tax elections that can be made on flow-through returns. I'm sure pretty much everybody is aware of the fact that, you know, the Tax Cuts and Jobs Act limited the state income tax or state tax deduction actually to $5,000 an individual, 10,000 filing married, what I want to say, married and jointly. That limit is now part of the tax bill that has been sent on to the Senate, where currently there has been a recommendation of an increase to 40,000. That's for married filing jointly, but I noticed in an article, a Bloomberg article this morning, apparently the Senate feels that it should be lower, and there's been meetings with the White House because it's kind of comes back to the conflict between the red and the blue states and what your tax liability is in the various states, with New York and California, you know, being two of the high tax states. So anyway, the general mechanics of the PTET election is you can either have a credit approach or a reduced income approach. So in the credit approach, the share of the income is passed through, but the owner receives a PTET credit, which they apply on the flow-through entity, which they apply, I'm sorry, on their individual income tax return. And some of the states do not give a full credit because they'll allow like a shaving because of the state tax rate. And the idea is to basically make people whole at the state level, but to have them, you know, pay or get the benefit at the federal level. And then some of the other states, and I've listed here what those states are, use an income reduced method, where they basically, you know, have a subtraction modification to carve out that income. This is a chart showing the states that currently have PTET elections. There hasn't been a real lot of movement on that in the past year or so. Interesting to note, states like Pennsylvania never did pass one. But then it raises a question is, you know, if you start upping the level at which people can deduct state taxes, and, you know, some of these states and, you know, with individuals, you know, only have a small amount of flow-through income, it may, you know, alleviate the need for using this approach. And there's also as part of that bill, there is a provision that is basically stating that really various types of professional service firms, I would call it, or where the principal asset of the trade of businesses, the reputation and skill of its employees, there's a provision not allowing that type of pass-through. But again, you know, the legislation obviously only passed the House at the moment, is at the Senate, and will be going through, I think, a lot of iterations before anything is sent on to the president. One other area that I want to talk about a little bit is sourcing revenue and taxability considerations. So, you know, we talked before about public law 86-272 protections and things like that. So this is an area where, at least the way I think about it, I don't know if this would be helpful for you, is when you have a sale of tangible personal property, you're going to source that sale to where it's the destination, you know, where it's shipped. Well, previously, or for a number of years, a lot of states sourced companies that had sales of services. They sourced the services to where that company's employees perform the services. You know, so if they perform them in state A, but their customers in state B, they still pick them up in state A. Well, throughout the years, I think what a lot of states started realizing is it's better policy if they try to push the tax liability to out-of-state taxpayers. So for example, if you have a company headquartered in state A and they're doing work for somebody in state B, the states have been shifting now to where it's going to be sourced more to where the customer is. And this is, and just to clarify, this would be only for service entities, not for sellers of tangible personal property, because they're already kind of doing something like that. So what happens is now suddenly when you combine that with the fact that there aren't public law 86272 protections for these service companies, and you have economic nexus provisions, well, how you source your sales becomes very important. So when you start thinking about nexus issues, you have to consider, well, how's the sourcing done in this state, versus in other states. So at the moment, there's, I think, approximately 36 states plus DC that have adopted market-based sourcing for sales of services and intangibles. And the definitions can vary quite a bit from state. And some states have very robust regulations. Like, for example, yesterday, I was just reading something in Tennessee where they had a very detailed regulation on different types of services and how they're sourced. Other states I looked at wasn't quite as developed. So these are some of the tests, that the states use. California, for example, where the benefit is received. And California has a more detailed regulation on this. There are also, I think there's proposed regulations out there that they've been working on for years that are even more detailed. Colorado, where the service is delivered. The Multi-State Tax Commission, if it's intangible, where the intangible is used. And then some states that didn't have market-based sourcing are now starting to adopt that for future years. So I think this list keeps growing, and this is what we're going to continue to see. But I guess the point I'm making is that it's sometimes not as easy to source these services as you think. If the services relate to an item of property, for example, that's a little bit easier to source than, let's say, you're providing services to a company that has locations all over the place, or you're providing, some type of payroll service to a company that has payroll all over the country. So this is one of the really evolving areas, I would say, in the state income tax area, and one of the more difficult ones. So I'm going to, so one thing that I did want to point out is sometimes companies distinguish between if they're providing services versus if they're licensing intangibles. I've given some examples, for Illinois and Texas, electronically delivered versus SaaS. You may end up with some slightly different sourcing rules in those states. The other thing to consider is some states have partnerships or S corporations use different rules for sourcing compared to C corps. So, for example, I usually think of Pennsylvania and New York as being, that's a big area for them, where those states for, flow-through entities will use like a 3-factor formula, when corporations use 1-factor, and they will look more at where the services are performed rather than where the customers are located or the market is for that. And then just to reiterate again, which I mentioned before, is that Public Law 86272 protections don't apply to service providers. And as I mentioned also, that Congress is kind of evaluating expanding these protections. So Chris, maybe some comments on sourcing for sales tax.
Yeah, I'm kind of keeping in mind a little bit higher level and generally speaking, but ways we're looking at sourcing for sales tax purposes, I think I typically look at it as a, ship to or where the customer takes possession of goods. And I can kind of take that broad as far as tangible goods versus intangibles or services as well. But we kind of have to look at services a little bit separately. But for the most part, when you're selling a tangible good, states are going to source where the customer takes possession. So for instance, if you had an in-store sale, the sale consummated at that location, that's where the sale is going to be sourced. If you're shipping products, from state to state or doing e-commerce, sourcing of that revenue is going to be based on that customer's ship to address, not bill to, ship to in that instance where the actual goods are being delivered. That's where we're looking at those economic nexus thresholds that, sales per state. The way we kind of look at sales is defining if it's again tangible, the ship to points to help us determine that. Services and intangibles, again, similar concept. There's no ship to with it. So what you see states is typically look at is the service benefit location. So where is that client receiving or taking receipt of the service benefit for the services provided? Definitely going to be more of a gray area topic, but when you're looking at this from a state perspective, or if you're getting audited, the trend line they typically go down is looking at, hey, what is the invoice billed to? What is the ship to address? Even though it's not necessarily a ship to, but they might look at, if in the case of a service agreement, where was the MSA or the SOW? Where was that consummation? Where was that signed, executed agreement performed? So you might be doing work for a headquartered company in the state of Texas, for that matter, and that's where they signed it. An auditor is going to typically look at trying to source the service to that location. Where it can definitely get gray is in the case where we have, and Karen mentioned it, with services where there's perhaps a headquarter location in the state of Texas, but they have either remote employees or branches all around the country. If there is connection and there's an understanding that those particular items that are being sold are actually being used and benefiting the various locations around the country, then we're kind of looking at trying to figure out that service benefit, where all that service benefit is allocated to from a sourcing perspective. So it could, instead of having a single contract at a particular headquarter, could potentially be something that needs to be looked at as a multi-state type of arrangement. And then looking at each one of those states' laws to see if they then tax it and how to be compliant too. But really understanding the facts of what service is being provided, where the true service is benefiting, is what we need to dive into first before we dive into the deeper details. So go ahead, Karen. In addition to sourcing, what we also have to start looking at then, to determine, I have this real simple little equation at the last bullet point, to determine, do we have some sort of sales tax collection and filing requirement? It's a combination really of, nexus. If we have a connection with that state or engaged in business, we probably have some sort of compliance filing, but that doesn't always mean that we have a liability that's accruing too. So we also have to look at taxability of our customer and then the taxability of our revenue. So we might have nexus, we might have a compliance responsibility, but do we have a sales tax collection responsibility at that point? And that's when we have to then start looking at, is our customer taxable and is what we're selling taxable? So various customer related exemptions are going to be, exempt organizations, federal, some state, local governments are going to be exempt. Manufacturers typically have a lot of exemptions that they're going to present, or purchase for resale, some of the biggest customer facing exemptions. If a customer has an exemption, they've presented it to us and it's valid and we've edited it out, then there's no reason to look at the taxability of the revenue anymore. It's because it's going to be a non-taxable transaction because of a customer exemption. In the case where a customer doesn't have exemption, we have to then start looking into, okay, are we selling tangible personal property, which is generally taxable in all states? So that's something to consider. And then, or are we selling a service? A little bit different, generally non-taxable unless specifically enumerated in those states. So states, if you look at it, generally speaking, taxing all tangible personal property. If it's a service, not taxable unless the state specifically enumerates it as taxable. And I've kind of listed out some of the more aggressive taxing states, aggressive states that tax services. You can move ahead.
Okay. The next area that we're going to talk about, and we're only going to spend a few minutes talking about this, because this is obviously a very broad topic, is salt traps during M&A activities. So first of all, from the income tax side, and I'm kind of focusing a little bit more, on due diligence types of issues. If you're buying a business, you have to consider, these are some questions that I pose, will it be an asset sale or a sale of the entity itself? And sometimes you can have a deviation between what it is for income tax purposes and what it is for legal purposes. So you have to be very careful in that area. And the reason is because obviously there's much broader assumption of risk on the income tax side if there is a sale of the entity. But even on the asset side, you have to be careful, because there are, I think, last I checked, there may be about 10 states or so that do have successor liability for asset purchases, even for income tax. The next issue is, what liabilities will be assumed? Are there a bunch of states in which the entity wasn't filing, had nexus wasn't filing? Was there a very aggressive position taken on one of the returns? Can you rely upon indemnity provisions? Do you need an escrow? In some cases, people even go with the bulk sales approach. That's a little bit more difficult to do. The bulk sales is where you file with the state. They're supposed to tell you whatever liabilities the company has that you're buying within a certain number of days, and then they make you withhold from the purchase price. So it ends up almost looking a little bit like an escrow, but that gets a little bit more difficult to do. Will retroactive filings need to be done? Do you need a nexus study? Can you do voluntary disclosure? How quickly can that be done? Who's going to be doing that? Buyer, seller, who's going to be assuming the costs for doing that, for example? And then also raising
Hey,
the issue.
Karen, I was gonna say, in M&A, guys, this is probably one of the biggest hot buttons when you're
Yeah.
going to sell the company. When the buyer
Yeah.
comes in and does due diligence, and they start throwing these technical rules that Chris and Karen are dealing with as far as nexus and services versus a product. And if it's a SaaS product, Chris hasn't really even dove into that yet, right? Whether it's a service or data processing and all that stuff. This is by far one of the biggest issues when you're trying to sell your company. So you got to get a handle on it ASAP.
Right, right. And then the other issue is, are there credits to carry forward? Are there 382 limitations on your NOLs? If you're buying out of a consolidated group, you're going to have different computations and separate state returns, or if you're not buying the whole group from what you might have for federal. And then as Jeff was referring to selling your business, you got to think about these issues long before you're putting the company on the block. And you have to consider the time that's going to be involved in selling your business. You're going to get a lot of questions from the due diligence teams. That was one of the areas that I used to work in. So I know from my own experience, we always asked a lot of questions. You're trying to understand the business. You're trying to understand what they did for tax purposes. They're gonna suck you into questions and answers, producing a lot of documents, probably a call, in terms of how you did how the tax returns are done. And then also an issue that we deal with a lot is, what about the gain from the sale of the business, and how will that be reported for income tax purposes? So I'm going to let Chris give some of the sales and use tax considerations in M&A.
Yeah, I think the big takeaway, as Jeff kind of pointed out, is, why get ahead of this? A couple of reasons. One, just doing the right thing and following the letter of the law, clearly is going to be the guiding point. But then we're looking at one potentially being audited by states, which again, depending on where the business is in the life cycle, smaller businesses, smaller revenue is going to be a little bit low on the threshold of getting audited. There's only only a certain amount of workforce, and so many companies do audit, and they're typically going out for material one. But the bigger thing I think really applies, and this is Jeff's call out, this is what I've seen with a lot of the client base up in the Boston market is, exit strategies or investment strategies, and a good diligence team on the buy side is going to really dive down into this. The main thing I want to point out with this is I'm kind of listing what you'll typically see in a diligence package from a good state and local tax team is looking at nexus. But the big thing is this third point, calculation of potential sales tax exposure for a 3 or 4 plus period. So most states have a 3 or 4 statute limitation that they can look back and grab exposure. That only exists if you've been compliantly filing returns for the last 3 or 4 years. If nexus is established in a given state and there's been no filing, the statute of limitations of 3 or 4 years doesn't exist here. So if Wayfair case came out for economic nexus back in 2018, you saw a lot of states adopting early, late 18, early 19, which is now sitting on 4, 5, 6 years back already now, where the states can, if we're not filing returns, exposure technically exists beyond the statute of limitations because there is none in this case because we weren't filing. And that's where these liabilities, if we look at an average tax rate of, call it 7.5 in a state, multiplied by all your sales for the last 6 years, this can be a really hot button issue in these diligence, in an exit strategy. Another, when we start, if there is material liability, What I've typically seen is sometimes it will, if it's large enough, it can be a purchase price adjustment. Most of the time, I've typically seen it in some sort of escrow holdback, as far as funds held back and then distributed back if the exposure is then not, number one, it needs to be remediated. And then if it's not either then identified by a state or made liable, it'll get paid back. But the idea is having to get compliant, starting the statute of limitations, and then, you know, a holdback being held up for the any kind of prior period exposure. A big thing for sales tax, which is different from income tax, dependent, no matter the structure, whether it be a stock deal, asset purchase agreement, whether it be reorg and drop the assets in a new, you know, liability, a new LLC, a new legal entity, is the successor liability is going to transfer and exist for the purchaser, no matter the structure. You know, in an asset deal, if it's dropped in a new LLC, the liability can follow those assets. So it's really, really important to have indemnity language in that purchase agreement, ensuring that there's all sorts of protections. I mean, there's no doubt in my mind that a good legal team helping with those arrangements are going to have that language already, but just understanding that can be, you know, something that's really important. For instance, again, if it's a new LLC is created with drop-in assets, asset purchase with drop-in assets in a new LLC, sure, that new LLC is just formed with the state and there's no really look back, but what you typically see when you're doing a new application for new LLC is in the application and the registration for sales tax purposes, it will literally say, like, was this a formation of a merger and acquisition? And they're trying to see, is there potential to grab those assets that were pulled into that company? And is there something that they can look back on for historical purposes too? So successor liability, no matter the arrangement, whether it be a stock purchase, there can be issues that are presented to the purchaser on the other side. So that's why it's really critical in the M&A space.
Okay, since we're getting kind of close to the top of the hour, we wanted to discuss some of the hot topics, but we'll probably move through these a little bit more quickly, also to see if we can leave some time for questions if there are any. But I would say on the income tax side, and I've kind of alluded to this in the rest of the discussion, there is this trend going more to market state approach. In the states, there's a trend also, more states are going to single sales factor instead of 3-factor formula. And more states on the income tax side are going to adopting some type of bright line factor nexus standards, although that still has been fairly slow. In terms of sales sourcing, when we talked about sales for services, there's this concept of who is your customer and how do we source based on who your customer is. So to give kind of two opposing points of view, New York had a court case where there were support services provided you know, basically to brokerage clients, but the services were actually, you know, provided to technically to the broker dealer, but they were support services to the broker dealer's clients. In these particular cases, the court held that the broker dealer is still the client. That is where you source the sales. On the other hand, the Minnesota tax court had a situation where there was an income from a pharmacy benefits management services. They were provided to an affiliated entity, which was not in Minnesota. And the argument was that therefore those sales should not be sourced to Minnesota. And what the court said was basically, we're going to look through the activity, and we're going to source them based on where the affiliated plan members are. So these are kind of some of the conflicting areas for sourcing at the moment. We also have changes in tax rates. And what I wanted to do was I gave you a site here. Our firm is now putting out a quarterly update on various state and local tax issues, and that is the site for it. You can go take a look at that. We should be putting another one out fairly shortly, you know, as we get to the end of the second quarter. We have some changes in the net operating losses. Again, California and Illinois, I'd like to suspend net operating losses, and those are some of the rules relating to that. Pennsylvania, on the other hand, is increasing the usage of the net operating loss from 40% each year, and then to where the percentage starts rising starting in 2026. But you have to be very careful, look at the underlying provisions, because they look at where the year in which the NOL arose in terms of determining those percentages. And then, we have this decoupling from the interest expense limitations, the 174 capitalization of R&D expenses. Not all states will follow what is done for federal purposes. And at the moment, the bill in Washington is apparently addressing the 174 capitalization issue. So that could change as well. So the long and the short of it is, for your state income tax return, your computation of that 163J may differ from your federal, and the same with the capitalization. Or you can have some states like California that never adopted the TCJA or the CARES Act, and they don't have these limits at all.
Yeah, a
Chris?
couple of sales tax topics, and I think what I wanted to kind of just address high level with this is, I mean, these are just Q1 2025 changes with these various states. So a lot of state activity happening. I mean, for the most part, generally trying to increase the tax base by passing bills and laws to increase the tax base for the revenue streams for these states. Very fluid. Again, 45 states that impose a sales tax. They're always changing, always moving. And what I want to point out here is we do produce a quarterly update that will run through some of these. Hopefully after this, we can all get subscribed and make sure you guys are part of that distribution list. But yeah, some of the ones on here that are more impactful. Certainly a big one. Illinois had a lot of movement recently. For instance, they didn't tax true leases before. Now they've included that as part of a tax base. That's a very big one for them. Now requiring remote sellers used to only be allowed to charge 6.25 into the state of Illinois. Now they're requiring remote sellers to collect both the state and the local tax rates. Local tax rates in Illinois can be upwards of, I've even seen 3.5%, 4%. So almost half of the potential tax liability that could be there if you're only collecting the state rate at 6.25. Maryland just saw this yesterday, came out and increasing the basis for certain data and IT services that were previously not taxable in the state. Now they're taxable, but at a reduced rate of 3%. That's a big one that came out. Ohio, only one that kind of moves in a, I guess, positive way for taxpayers is they have a tax called a commercial activities tax, which is kind of like gross receipts, business occupation type tax. They increased the exemption on the first 6 million. It was 3.5, I think, before. Now it's 6, so a little bit lower threshold. And then I have seen this across a lot of states to kind of combat and compete with the market base for Airbnb and VRBOs. You're seeing a lot more increases in various lodging or meals, rooms taxes on short-term rentals, which is something that, again, states weren't grabbing as much, but because of technology advancements and anyone able to sell or rent their home or other, lodging up, trying to grab that. So trend here really is states are always going to be aggressive, always looking to increase their tax base, and we're seeing laws kind of moving that direction, throughout the year. So.
Okay, want to be sure we get our polling questions in. So what are some of the trends in state and local taxation? A, use of PTET. B, more states adopting a market-based approach for income tax. C, potential changes in Public Law 6272 protections. And D, all of the above. Okay, 100% again, great. So the final topic is, what are some of our SALT triggers and some planning opportunities? So we're kind of listing a number of things, and there could be many more. If you have a change in key management personnel, they may want to take a new look at things, have a change of business operations. You have material capital expenditure investments, or you have sales of assets. You have to be careful when you sell your assets. You can't assume of your business. You can't assume that that's going to be exempt from sales tax. Evaluating a business exit strategy, pending life cycle events, merger, acquisition, disposition, so going into a joint venture. You have audits going on. Who doesn't, right? Notices, assessments, planning that maybe requires some type of transfer pricing documentation and regular updates. You see that a lot on the income tax side. Debt restructuring and how that is handled. It may vary on state for state purposes, and it does for federal. Can't always rely on consolidated rules to get you out of certain things. Complex legal entity structure or no planning at all. and maybe upgrading your ERP system. So Chris, I don't know if you had more comments on any of those?
No, basically, a lot of matters can trigger some sort of state and local tax consequence for sure.
Almost anything can, right?
Yeah.
Okay. And, you know, and this list is in no way exhaustive, but these are some of the types of things, you know, that can be considered in dealing with some of the issues that we talked about. You know, your legal entity optimization, rationalization, you need to kind of think about, though, what does that do for nexus for prior periods going forward? As we talked about, you know, sale of assets, you know, what happens if you need to move asset, even just sometimes moving assets from one company to another could raise some issues depending on how it's done. You know, various compliance filing elections, apportionment factor planning, tax attribute identification, your NOLs and utilizations, how you use your credit. And basically, you know, just making sure that if you had planning, you've changed your structure, thinking of changing a structure, be sure you know, rethink what you've been doing and whether that needs to change.
I thank you, Chris. Thank you, Karen, for this today. Obviously, you guys see the technicalities here, and this is like doing business in 50 different countries, right? And you really need to know the rules, and you really don't want to mess this up. So feel free to reach out to us. We appreciate you spending the time with us today. And, you know, reach out to Karen if you have specific questions, or Chris, or obviously our office as well here in Boston, and we're happy to connect you. Okay. Thanks,
Right.
everybody. Have a great day.